In this video, we're going to be looking at bullish and bearish flags. Some of the objectives discussed in this video include recognizing flags in real time, real life situations, and the second of which looks at identifying the completion of flags. The final objective for this video gives two ways to derive price targets from flags. So let's begin. A bullish flag is a bullish continuation pattern. It has a rapid advance in price, so that rapid advance is where the flagpole is formed, followed by a pullback in the form of a descending parallel channel. So that descending parallel channel is called a flag. The pattern is complete as soon as the two trend lines which contain the channel are established. Let's get an image here just to give some context. We've got the parallel channels, and then we can see that that trend line has been established. So that is when the pattern is complete. It is not necessary for the breakout of the channel to occur for the pattern to be complete. And volume should be strong through the initial advance, then contract during the descending channel and expand as price breaks out to the upside. So you have descending volume as the price is trending. And then you have a huge breakout in volume in this side because of a breakout to the upside. You would get a lot of buying volume, probably more volume than you've seen before. In this case, that would be the kind of circumstance. So volume is once again descending, or should we say contracting, in this trending area, this trend line here. You can see the two descending parallel channels, and then you see a little breakout. When that breakout occurs, volume is normally much higher. So let's give an example here, because there are there's actually two ways to derive price targets from flags. The first is using a measured move based on the height of the parallel channel. The height of the channel in this case would be measured and then projected upwards from a point of breakout. And we can see here we got it highlighted in yellow. This is the height of the channel, and that is put on top. And then you have your one-to-one area. So Boeing shares in this example rallied after the breakout up to the one-to-one target, and they later rallied up to the Fibonacci 1-to-1.618 target, which acted as resistance. And note, in this case, there was contracting volume throughout this channel kind of phase. You can see the volume was declining as we've labeled it. And then the expansion in volume occurred as the shares broke out and rallied up to the one-to-one target, which is there. That's a one-to-one target. And this is the expanding volume you can see. And it's interesting how this works on just the casual company we picked, which we looked at Boeing for this example. So the other way to calculate the price targets is to take a measured move based on the flagpole. So the height of the flagpole is measured and then projected upwards from the point of breakout. We can see here on CAS Mineral shares that the share price rallied after the breakout up to the minimum 1-to-1 target, and it also met the 2-to-1 target after. We can see the height of the flagpole here, just to go over it again if anyone wants one more cycle through this. So we can see that's the height of the flagpole, top of the flag, bottom of the flag, and we've just gone to where this breakout occurred from these descending parallel trend lines. We can see the channels there. We can see that if we connect it up, that's the one-to-one projection target, and that seemed to have a fair bit of res before the 2-to-1 projection was seen. So again, notice in this case the declining volume throughout the channel. That's the channel, those two dotted blue lines, and you can see the declining volume is on par with that, and the expanding volume on the breakout here. The volume actually increases. You can see it's trending to the up as the price breaks out as well. So a bearish flag is intuitively the bullish flag on the other way around. So it is the opposite of the bullish flag. It's a bearish continuation pattern, and there's a rapid decline. Hold up, we've got the rapid decline there, followed by the formation of an ascending parallel channel. And price is expected in this case to break out towards the downside, hence the name bearish flag, and continue downwards. So let's see if we've got a little graphic here of that as well. There we go. So the confirmation in this case, I think we should probably mention that point too, comes as soon as the trend lines are in place. There's no requirement for the price to break out before the pattern is considered complete. You can see the flagpole is formed, you have the trending channels, and we can see that both trend lines are moving to the up, and then you have the breakout to the downside. So again, in this case, volume is expected to decline during the channel and expand during and after the breakout. So here's a bearish flag in Japan's stock market. This is the Nikkei 225. There are actually a few bearish flags in this chart, if you've probably noticed yourself already from what we've talked about just in the early parts of this video. Some are quite small, but we'll just focus on this one. So using the same methods as a bullish flag, we can get a one-to-one target based on the height of a channel by projecting downwards from the point of breakout. So let's see here. We can see the dotted blue lines, the trend lines here on the bearish flag. We have that point where it seems to break below, and that's the breakout point. And we will simply extend that same distance to be to the one-to-one target point. And the target in this case was hit very swiftly. So it's interesting how this process seems to yield results from another random scenario. So we can also get a lower target using the flagpole, and that's by measuring the height of the flagpole and projecting it downwards. This is the second method as seen before, and we can use this target, or we can see this target rather, and how it was hit to and acted as a rough area of support. So let's see that height of the flagpole, and we can see the bottom of that area, and then we project from wherever the breakout point is, and you can see that you have your one-to-one projection target based on the flagpole right here, and it seems to be an interesting area of support, especially around this late 2008, early 2009 area on the Nikkei 225. The one-to-one target with the flag circumstance had a level of support and resistance here, and you now see the flagpole one-to-one projection has support here that probably, if the markets were to go down again, you would probably use that as a level of support for your analysis. So, to conclude, flags are very popular patterns to trade because they're relatively easy to identify. Many people with a preference for a non-mean reversion approach like flags, and that's because they're continuation patterns, meaning the trend sentiment is always on side, unlike reversal patterns. Targets in this case can be derived either from the channel width, remember the channel width, or the flagpole itself. So from the top of the flagpole to the bottom, that height, then project that from the breakout point, or on the channel width, you do a similar thing, and then you project that, you get your one-to-one movement. You can get your 1 to 1.61 if you're, 1.618 if you're a fib nerd, whatever you decide to do. But the flagpole itself is usually useful in determining targets for bigger moves which go beyond the nearer term target from the channel width.